What is up, guys, and welcome to lecture 5B of the TCT mentorship, where we will be going over real trading examples of different TCT schematics. Okay, so in lecture 5A, we went over what a TCT schematic is, the theory behind it, the requirements of a TCT schematic, the confirmations, the targets. We've made the comparison to Wyckoff and the difference between the two. And now we will be going over real trading examples to clear up any confusion or misconception that you might have now regarding TCT schematics, because it's always different when you see real candles versus me drawing it, right? So we're going to go over different examples of Model 1s and Model 2s of accumulations and distributions, starting off with Sol. Okay, we're going to start off with Sol. So with Sol, we came into this area of resistance, okay? Later on in the mentorship, I'll be doing different trade examples going from macro to micro with building context. For now, we're just going to focus on the schematic itself, okay? So just know we came into an area of significant resistance where we can expect a potential rejection, okay? So going on the 30-minute time frame, we can clearly see that coming into that resistance, we were making higher lows and higher highs. We were uptrending. We know that in an uptrend, we pull our range from top to bottom. There you go, top to bottom. And a move back up towards that equilibrium of the range confirms our range. So the moment we touch that equilibrium right there, that is when our range is confirmed. Now, you already see I have the DL2 on my chart to check for potential deviations. And I always want to check when I have my first deviation, what is the highest time frame that this range is valid. Okay, so we can see the 6 candle rule. We can see 2 candles up, 2 candles down, 2 candles up in that deviation, because I also want to check what the highest time frame is that my TCT schematic is valid on. Okay. Going on the 45, do we still have that? Still the 2 up, still the 2 down, still the 2 up. There you go. On the 1 hour, no. So on the 1 hour, we don't have a valid range and a deviation anymore. Why? Because we don't have 2 consecutive candles going from range high to range low, okay, that are bearish. So we have a 45-minute range. This is the highest time frame that our range is valid on. And we can see we came above it, staying in that DL threshold, okay? And then we came back inside. So after coming back inside, we extend our range to our new range high, and we're going to look, hey, that first deviation is already our first sign of a distribution. Now we're going to check where is the requirement for price to come if it wants to be a model 2, okay? And then we're just going to check structure, and we extend our range high to our deviation high to watch for a potential model 1. But at this point in time, we don't know if it's going to be a 1 or a 2. Okay? So I'm just scanning. I want to identify the market structure from this high to that low, because this is our tab 1, this is our tab 2, and this is our tab 3. So in order to check where is my extreme supply and what is my highest market structure high from the top down, we check the structure from the second tab high towards the lowest point between tab 2 and tab 3. That's between these 2 points. So I'm going to go down the 10-minute, and I can see if I draw structure on the 10-minute, I have a high, lower, low. They messed my magnitude up there. There we go. I'm also going to check on the lower time frame, on the 3-minute right here. Let's get rid of this. On the 3-minute, you don't really have any significant structure. It's very sketchy. You do have a high up here. Okay, you do have a high up there, which is pretty close to that second tab high, but it's still doable. We can still wick it and go down. So what I'll do is I'll use my 3-minute high because it's decent distance away from my second tab high. And I'll grab this and I'll use this as my extreme liquidity, okay? Because it's the a lower time frame first market structure high, right? Now I'm checking where do I have a significant supply. that's still unmitigated. Well, I can see a 3-minute order block right here, but that order block already got mitigated on this candle. And then I can see a 3-minute order block right there, but that also got mitigated. So we kind of have our order blocks already getting mitigated. Now I'm scanning through my time frames to see if I have any structure supply or structure or order blocks. And if I go on the 10-minute, scanning through my time frames between these 2 points, I see that first marker structure pool that we just discussed, and that actually is valid structure supply because it has that imbalance. Okay, it has that imbalance. So you see the structure supply with the fair value gap right here, making it a valid structure supply. So this is the only valid supply zone. Therefore, also your highest valid supply zone, right? So if price comes either into this area or grabs this or does both, okay, we meet the requirements of a TCT Model 2 distribution. Okay, now to confirm a TCT Model 2 distribution, we need to break structure. Okay, well, we can clearly see that from the low up, we have a low, we have a high, we have a higher low, and we have a higher high, and we have a higher low, and we have a higher high, higher low, higher high. So clearly, structure never broke, indicating that this TCT Model 2 distribution never got confirmed. Okay, it never got confirmed, so you would have never gotten trapped into thinking that this was going to be a Model 2 distribution. We keep on following our structure, and now we already took out our second tap high, invalidating our potential idea of a Model 2 distribution, okay? And now we're checking for a potential Model 1. Now, we extend our range high, which we already did. We check, is this deviation in our DL2? Yes, it is. It didn't even come close to exceeding it, making this a valid third tap. Now we need to wait for a structure confirmation. So I kept on drawing that structure from high to low like we just did using the 6 candle rule, okay? From high to low. And I told you guys, preferably we want to have a break of structure of this uptrend from our lowest point between tab 2 and tab 3 up towards our third tap high. And preferably we want that break of structure to be inside of the original range values. We have a break of structure underneath that second tap high, being back inside our original range values. And right here we have that candle close below it, indicating and confirming our TCT Model 1 distribution. So what do? We can enter on the break of structure. We put our stop loss above our third tap high, and we target our range low. Look at that, guys. A TCT Model 1 distribution, where we have each deviation going higher than the previous one, staying in our DL limits, okay? And we enter on the break of structure back inside our original range values with our stop loss above our range high, and we target the low. We would have never gotten trapped into thinking we have a Model 2 because we never broke structure from the low up. Okay? This was our first TCT Model 1 distribution. And you can already see here that while coming up, we have a sneaky little liquidity trail, right? Where each low is a higher low, leaving no demand behind and just stop losses, therefore also making the move down pretty smooth. But that is something for another lecture, okay? Let's get into the second one. So, right here, we can see that we have Peppa, and we have the Peppa chart open, and we are basically in a range, okay? You guys should know in a range, we can have many internal rotations, and we can also have ranges within ranges. Right here, we had a 30-minute order block at the bottom of our range. That's where we bounced from. And our highest time frame structure pool from the bottom of our range is the 30-minute time frame, where we have a high, a low, and a higher high. We have an uptrend right here on the 30-minute time frame. So in an uptrend within our bigger range, we pull our structure, or we pull our range from top to bottom. And we have our range high, and we have our range low. And right here on the touch of that equilibrium of the range, we confirm our range. I always want to check what is the highest time frame that this potential first deviation and this TCT schematic is valid on, and our range. I go on the 45. Well, look at that. We have 2 candles up. Right here we have 2 candles down. Right here we have 2 candles back up again. So it's a 45-minute range. Is the range on the 1 hour? Yes. We have a high, 2 candles coming down, and 2 candles coming back up, touching that high. Is it a 2-hour range? Oh, it's even the 2-hour range. 2 candles, 2 candles, 2 candles. Is it the 3? It's even a 3-hour range. That's pretty crazy. But the macro range is not valid on the 3 hour, so I wouldn't use that. I would use the 2. So right here we can see from this high to this low, we only have 1 downwards candle, and by accident we actually have it in the meantime. So that's when I wouldn't use this as a 3-hour range, but the 2 hour is fine because the bigger range is also valid on the 2 hour. So we know the 2 hour is a valid range. We go on the lower time frame and we can check. Okay, we have that first deviation well inside of our DL2, and it's even a wick, right? It's even a wick, so there's nothing to worry about into potentially thinking that this is a break of structure, because wicks are clearly an indication of deviations, okay? So we have our tab 1, we deviate our range high, showing first signs of a distribution. Now we check, where can we have a potential model 2, or obviously we can have a model 1. So we extend our range high to our deviation high, and we check, okay, what is the market structure. Let's say price is right here. What is the market structure between this low and this high? Okay, because this is our tab 1, this is our tab 2, and at this moment in time, this could potentially be our tab 3, but it's not sure yet. But let's check it. We go on the lower time frame, and we can clearly see that on the 5-minute, we have a little order block in that pivot point of the deviation, which is absolutely beautiful. So let's make that our order block. Nothing on the 10, nothing on the 15. Is there something on the 3? No. Also something on the 2. There's a 2-minute order block right in there. Something on the 1. No, not really. The only structure there is, guys, because we know we either have to mitigate extreme supply or grab extreme liquidity. The only structure that there is this 1-minute structure pool. That's the only valid structure using the 6 candle rule. And we are trading a higher time frame range. So we need the 6 candle rule to validate extreme liquidity. It's not a low time frame range, which was the exception. Okay? So this is our extreme liquidity. So price has to either mitigate extreme supply or grab that extreme liquidity point. So we can clearly see that when price was retracing here, there was no confirmation for this to be a third tap because it didn't mitigate extreme supply nor extreme liquidity. And obviously price ends up coming back. Okay, price ends up coming back because it just wants to mitigate that supply or grab extreme liquidity before having a substantial move towards the downside. Now, the moment we tap it right here, this could be our potential 3. Now we have to wait for confirmations, okay? So we check, what is the lowest point between tab 2 and tab 3? That's right here. And now let's draw our structure. Structure from the low up, guys, is low, high, higher low, higher high. However, waiting for this low will make you enter in almost extreme discount. If you enter right here, you have to put your stop loss above that third tap high to target the range low, which is a 0.67 risk to reward, meaning you will risk 1 and you will gain 0.67. That's not good. So what do we do, guys? We identify and dissect this last market structure leg into potential more lower time frame structure. What can we see? Right here on the 2-minute, we can see a low, high, higher low, higher high, higher low, higher high. Let's make that blue. Right here, we already have our blue market structure drawing, and that's where the bigger break or the higher up break confirms. Okay, so that's already where we enter. Right here, we get a candle close. We get a candle close below our 2-minute low. We put our stop loss, that's where we enter. We put our stop loss above our third tap high, and we target the range low. We just have to pay attention to what happens once we start coming to this low, but you can see that we already immediately broke it, and a lower high for a lower low followed, so nothing to worry about. Beautiful. 1 tap, 2 tap, 3 tap. This could have never been the third tap because it didn't mitigate anything. This was a valid third tap. Now we just needed to wait for our structure confirmation. This was our main market structure low from the lowest point of tap 2 and tap 3 up towards that third tap high. But that was not useful because it was so low. So we dissected it down more and waited for the break higher up, which was in premium pricing, giving us a risk to reward of 2.19. Now, let's do another one. Right here, we are actually on a higher time frame schematic this time. We came into a crucial area on the chart right here. A crucial area. Okay. Came into a crucial area on the chart right there, and we could potentially expect a rejection. Now, looking at our structure from the low up on the higher time frame, okay, we can see that we have a low, high, higher low, and then a higher high. Let's make this our red structure. So we're trending up on the 6 hour. This is our uptrend on the 6. In an uptrend, we pull our range from top to bottom, and a move back up to that equilibrium confirms our range. Okay, now, right here we have our initial range high. Right here we have our initial range low. And then we're going to check for deviations, okay? Right here, we deviated our range high. Is this a 6-hour TCT schematic? Well, it's only valid if I can draw if I could draw a structure following the 6 candle rule. High, low, high. Do we have a low? Are we coming down with 2 consecutive bearish closing candles trading lower than each other? No. So this is not a 6-hour schematic, potentially. On the 4, oh, look at that. On the 4, we do have a pullback, okay? So this is a 4-hour TCT schematic. Now, after that first deviation, let's extend our new range high to our deviation high to watch for a potential model 1, right? And let's zoom in even more to check maybe for a potential model 2. Now, we can see, okay, we have our model 1, or we have our range high, and we have that first deviation. And right here, we have that 30-minute order block sitting at the high. Now, guys, this is your tab 1. This is your tab 2, okay? The moment price came back up here, I wouldn't like to call that my tab 3. Either way, looking at it, we never broke structure, okay? We never broke structure. We went up in one go, okay? We went up in one go. However, we know that this is a 4-hour TCT schematic, okay? So to have your tab 3 already here, look at the difference in the distance between tab 2 and tab 3 versus tab 1 and tab 2. Tab 2 and tab 3 are way closer. And this is actually something we're going to talk about in the advanced section and lecture regarding low time frame schematics, going over into higher time frame schematics. But for now, just know that preferably you want your tabs to be somewhat more or equally spread out. So tab 2 and tab 3 here are extremely close compared to tab 1 and tab 2, because it's extremely close, because we know if we zoom out on the 4, it doesn't even look like a tap. It's not even a tap on the 4 because you cannot draw structure. So this wouldn't be a model 2 on the 4 hour, right? Because there's no 2 candles up here. So either way, I'm just telling you this already now. You want your taps to be somewhat equally spread out. But either way, we pumped very aggressively, leaving no structure behind here, also giving us no confirmation. So there was no reason to get trapped here. Absolutely no reason. Furthermore, referring back to when can we expect the Model 1, when can we expect the Model 2, we had this very important key supply zone on the chart higher up. So the moment you have a 4-hour schematic, you can think, hey, we can have a Model 1 coming into that supply zone, and then we can short it back down. Okay, and then we can short it back down. Now, that is also exactly what happened. But either way, if you were looking at a Model 2, you would not have gotten trapped because you got no breakup structure after mitigating extreme supply. So right here, we deviated our new deviation high one more time, indicating a third tap, right? This could be our tap 3. Now, how do we confirm this tap 3? If we break structure from the lowest point up between tap 2 and tap 3 up towards our third tap high. So just drawing our main structure, and we can already check, hey, on the 4 hour, is this a valid schematic? Yes, it is a valid schematic on the 4, because you can see 2 candles down and 2 candles here back up again in that deviation. So this stays a 4-hour TCT Model 1 distribution schematic. Now, let's check our main structure from the low up, right? So our main structure from the low up is we have a low, we have a high, we have a higher low, and we have a higher high. Okay? So our main market structure low would be right here. But again, guys, if I wait for a break all the way down here, I would enter on this break, and I would have to put my stop loss above my third tap high, and my target is the range low, only giving me a 1-to-1 on a very, very high time frame schematic. So it would take 2+ days to only realize 1%. That's something I don't like. So can we dissect this last leg even more, this last expansion up? We can dissect it even more using our blue market structure pool. Actually, let's make this black. Then we have our red right here. This low is here as well, but it's the same story, right? It's kind of the same story of, hey, if I have to wait for that low, that's almost near my black low. So we can go on an even lower time frame on the 15-minute and dissect this red market structure leg even more. That's when we have a low, a high, a higher low, and a higher high. Let's make that blue. See how I'm using the overlapping structure in my TCT schematic? This makes it our blue low. And we know the domino effect. Break blue, go to red. Break red, go to black. Break black, go all the way down. Now, we can see we just have to make sure that our blue market structure drawing break is back inside the original range values. This black line is our original range value high. It's that second tap high. So this blue is inside of its original range values, not making it risky, and we can enter on the breakup structure here of the blue, put our stop loss above our third tap high, and now we can target the low for a 3 risk to reward, making the result and the gain 3 times as much as if we would have waited only for that black market structure drawing to break. And you can see exactly what happened. We have our 1, we have our 2, we have our 3. Our blue market structure drawing confirms it, and then we target the range low, and look at what happened. Absolutely beauty of a TCT Model 1 distribution on the higher time frame. Now, understanding context also a bit more, guys. Understanding context also a bit more. Right here, we had this massive range going on. We came into a order block at the range high. This was our extreme order block because it was the last order block remaining before taking our range high. We were in premium pricing of the macro range, creating a 4-hour TCT Model 1 distribution. So if you combine that context, knowing you can have many rotations, you could have taken this trade even all the way down, which is also exactly what happened. And that's why, based on these confirmations, I called this on my X. This is the short that we called. It was that simple. TCT Model 1 with a blue market structure drawing break. And then we can target, in this case, a full range reversal, netting you over 10% in a single trade. Now, lastly, for the distributions, let's look at one more on Solana. So, right here, we came into a very good area of resistance. It was probably an order block with inefficiency that was just waiting there. And let's look at how we came into that block. Okay, we were expecting a rejection there, and coming into that block, let's look at our 30-minute structure. That's decent. So we had a high, higher low, higher high, higher low, higher high, higher low, higher high. We have our red market structure drawing. We know in an uptrend, we pull our range from top to bottom. This is our range. This is our top. That's our bottom. And then that first deviation came into that supply, right? So we have our range high. We have our range low. A move back up towards the equilibrium of the range confirms the range. And then we see that first deviation mitigating that supply zone, right? And also wicking our DL2, indicating that this is a valid deviation. And now we want to check what is the highest time frame that our TCT schematic is valid on. So going to 45, we have 2, 2, 2. Going on the 1, we also have 1. Do we have on 2? We have 2 candles going up, 2 candles down here, 2 candles going up. It's also on the 2. It's even on the 3. It's not on the 4. Oh, it is on the 4. It is technically on the 4 because you have 2 up. Right here you have 2 down, then you have 2 up again. So this is a 4-hour range. It's not on the 6. So this is a 4-hour range, which is pretty significant, pretty high time frame range. Okay. Always be aware of what the highest time frame is that your TCT schematic is valid on, because it will help with the advanced section. Okay. I just want to program that already into your mind of always check the highest time frame that your TCT schematic is valid on. So we have our 1, we have our first deviation that already mitigates supply, showing signs of a potential distribution because we are deviating our range high. Now, talking about when can we expect a Model 1, when can we expect a Model 2, this was the only good looking area of resistance, and we mitigated that on our second tap. So there isn't per se a reason to take that high one more time. There isn't something remaining above this high. So my expectation in this situation would be a Model 2. Now, either way, we trade confirmations and not expectations, but it is the expectation, okay? We have our range low, we have our range high, we have that first deviation that was valid using our DL2. Now let's extend our range to our deviation high. Now, the moment price is all the way down here, okay, we're coming down, we're going to check where would it be valid to have a third tap of a Model 2. Because obviously for a Model 1, we just take the range high that's already located right there. I'm on the 1-hour time frame now. Let's dissect it even more. 45, Nothing on the 45 from a structure perspective from top to bottom. On the 30, oh, would you look at that? On the 30, we have a high, we have a low, lower high, lower low, lower high, lower low, kind of lower high, lower low like this if we enter or we watch the chart from that POV. What is our first market structure high that was created? That high right there, making this our extreme liquidity point, okay? We can even see that below the extreme liquidity point, we have nothing but a liquidity trill, or even, I think this is trendline liquidity. Would you look at that? Where you have all these highs that are lower than the previous one, okay? No supply in the meantime, making this a beautiful trendline liquidity. Therefore, therefore also, if you realize from a market maker perspective, okay, if we want to have a model 2, aka needs to fill more shorts on the last move up, well, look at this beautiful buy side liquidity trend line. Obviously, he will take that out, and all those buy orders will fill his sell orders, referring back to the liquidity lecture. Okay? He takes all those highs to fill his shorts. Now, we know this is our obvious liquidity point, and sometimes, guys, when your liquidity point is this obvious and it's backed by this liquidity trail, I'm really just focusing on the liquidity and I'm not as much focusing on the supply, okay? But we can check on the lower time frame if there's something of supply. We can see right here a 10-minute order block at the highs. So you can kind of put that on your chart, but I wouldn't even look at that supply. I would really want to grab all that buy-side liquidity, okay? Really want to grab all that buy-side liquidity. We have nothing above here from a supply perspective. But as you can see, the moment price comes back up and we mitigate that supply and we grab that high, which in my opinion is the most important, we have to check our market structure to confirm a potential TCT Model 2 distribution. Again, this is our tab 1. This is our tab 2. This is our tab 3. What's the lowest point between your tab 1 or tab 2 and your tab 3? That's right here. So let's look at the structure from the low up, from the lowest point between tab 2 and tab 3 up towards your third tab high. We have a low. We have a high, higher low. I'm going to skip over these first few points because, we can see already more structure pools here, which will cause a new higher low. Higher low, higher high, higher low, higher high. There we go. Right here, we can see that this is around our 3 to 5 minute market structure low right here, making that our market structure low to break. Okay, so the moment price has a close below that low, that is our short confirmation. Okay, so right here, the moment we break that low, we can go short. We put our stop loss above our third tab high, and then we target the low for, in this case, a 1.1 risk to reward. Okay, so the risk to reward was a bit less good, but you can see it even had some more follow through, and it went all the way up to around a 2+% gain. Now, there was a way you could have refined your entry here using high probability Wyckoff concepts, which is something we will get into in later lectures. But for now, already understanding this, you know that right on that break, price is going to come towards the range low prior to taking out that high if it wants to do that later on. Okay? And we confirm our Model 2 TCT distribution schematic. Now, let's look at our accumulations. Okay, let's look at our accumulations. So, as you can see right here, I am on the gold chart because TCT works on anything, on a stock, on a commodity, on Forex, in crypto, you name it. Okay, I can already see that right here on the lower time frame we came into some form of demand. It's not the best, but it's something, right? It is something. I can see that we're trending up, so potentially we have a higher low for a higher high here. Who knows, or who knows, but locally we are trending down. From this top we have a low, lower high, lower low. Can clearly see that this is our range low. We take it towards that high. That is our range high. And then right below that range low, we have demand, okay? Which is also something I was telling you guys about in the supply and demand lecture, where the good places for supply and demand to be located is either at the top of your range for supply, at the bottom of your range for demand, and especially above and below your range points. Okay, see how everything is intersecting with each other, guys. All the lectures is all coming together in the TCT, or while trading TCT schematics. So we can see right here we have a range low, we have a range high, price comes back confirming the range. Always check what is the highest time frame that your TCT schematic is valid on. I'm going on the 15. This is 15-minute structure. Boom, 2 candles down, minimum of 2 candles up, minimum of 2 candles down. Going on the 30. It's not particularly on the 30 because we don't have 2 consecutive candles going higher than each other. So it's really a 15-minute range, okay? Range low, range high, 15-minute range. Right here, we have the deviation of our range low, staying in our DL2, coming back inside. Already looking at this without our DL2, we can see we have a very bad break of structure, meaning it is a range deviation. Now, this is a clear example of, waiting for a structure confirmation, because technically speaking, we had a demand mitigation on our second tap, so price wouldn't really have a reason to come back for that low again from a demand perspective, right? There's nothing really significant here for a refined area that price could potentially tap into. So our expectation could be a potential model 2. So the moment price is up here, we're going to check, hey, where is our model 2 requirement met? I can already see on the 5-minute time frame right here, look at this 5-minute order block exactly in that pivot point. It's a 5-minute demand zone in a 15-minute range. That's very nice. It's in that extreme discount area, right? It's in that extreme discount area where this is your discount and this is your extreme discount, and it's below in that extreme discount area, which is extremely nice, okay? Always demand zones in those pivot points of the deviations are perfect for Model 2s. So we know if we tap this demand, our requirement is met. Now also, let's look at structure. Well, I zoom in on the 3-minute time frame, for example. I see a low, I see a high, I see a higher low for a higher high. This is our first market structure low, making this our extreme liquidity. So if it grabs extreme liquidity, or it mitigates extreme demand, or both, our requirement is met for a Model 2. That is our expectation. That is our expectation. If we look at structure from the top down, because that's how we confirm it, right? We have a 1, we have a 2, we have a 3. What's the highest point between tap 2 and tap 3? That's right here. So we check our structure from top to bottom. We can see a high, low, lower high, lower low, lower high, lower low. Right here, if we break this market structure high, that confirms our schematic. And you can clearly see, right? You can clearly see that we never broke it back to bullish when tapping and mitigating our extreme demand and extreme liquidity. So there was no reason to get trapped into potentially longing a Model 2. Now, this break of structure is far above our equilibrium, meaning if we enter here, the risk to reward is very bad because we have to enter here with our stop here and our target here. That's a negative risk to reward, or not negative, but very little, right? So let's see if we can dissect our market structure even more, right? Let's go on the 1 minute. Well, would you look at that? On the 1 minute, we have a high, low, lower high, low, lower high, lower low, making this valid blue market structure, okay? We just have to make sure that our blue market structure break is back inside of its original range values, which it is right on that blue break. So you can go long on your blue break of structure right there, stop loss below the low, and then you target the high. Do you see the difference in risk to reward? Here you would risk 1 to make 2.94 versus risk 1 and make 0.62. We just have to make sure that that break of structure is back inside of its original range values, which it is. So it is a clear example of not really expecting a Model 1, but either way, you're not getting trapped because you wait for confirmations and you don't trade your expectations. Now, let's look at another one. Right here, we have Euro USD. a nice little Forex example. Okay. So we can clearly see that price is locally trending down. Okay, let's go on the 1 hour. Not even the 1 hour, more 45-minute to the 30. We can see that from top to bottom, right? From top to bottom, we have a high. Not the 1 hour like I just said. We have a high. We have a low. We have a lower high and a lower low. Okay, this is a lower low. It's a wick ever so slightly. So what we do is we pull our range from bottom to top. There we go. Bottom to top. And we identify our range low, our range high, and right here we confirm it. I say always check the highest time frame that your range is valid on. And in this case, that is the 45-minute, which you just saw me do, because if I go on the 1, you don't have that as 2 candles going up again, okay? Before the 2 candles coming down, taking that low. So the TCT, potential TCT schematic is only valid on the 45 right now. And then what do we see? Right here, we missed our high ever so slightly, showing 0 signs of a distribution from this range POV. And right here, we took that low. Just to clarify, we took that low ever so slightly, okay? And it doesn't have to be a big wick, but it just has to be a deviation, okay? So we took that low, and then let's go on a lower time frame to get more details about the range. This is our range. This is our range low. Here's that deviation. Okay. So the moment we get that move away from our deviation, we check, hey, where is our requirements met for a model 2? Okay, because we already extend our range low to the deviation low for what to watch for potential model 1, which is in this case almost similar. Now let's check for our model 2. Well, obviously, our most clear market structure pool from the bottom up is high, higher low, higher high, right? Making this your market structure low and also your extreme liquidity point, right? Now, as you can see, in that pivot point, we have a 10-minute order block. If I look at my order blocks, you can see right here, we have this last downwards candle before the push up, leaving it's a tiny imbalance, right? It's a tiny fair value gap, but it is one, because this does not mitigate that high. They're not the same. This candle's low and this candle's high are different. And I told you, you don't need a big fair value gap. You just need one, okay? So this is our 10-minute demand zone. Also, again, guys, this kind of falls into that discount section. It was a trickier one. This is our discount section. This would be a more extreme discount. It just fell above it. And that is why I was also more hesitant to take it initially on that demand bounce. Because if we zoom in, we can see that we have a 5-minute demand zone inside of our 10-minute demand zone. And that 5-minute order block would be in that discount section or extreme discount section of this range. And this is why market structure is so crucial and market structure is king, okay? Because preferably, I would have wanted a mitigation of this demand zone, right? But because we have a 45-minute range, right, I'm not going to make this my requirement of a Model 2 where this demand has to be mitigated. No, I would just use this entire range because this entire range is in discount, okay, and almost in extreme discount. And it looks good on the 10, right? And I'll just have to wait for market structure to see if we will reach this point and this point or only this point. So the moment we come down, we have our tap 1, we have our tap 2. This could be our tap 3. It meets the requirement by tapping that demand zone, okay, because we use the 10-minute zone, not only the 5, but we know that they're both there. We just have to check what is the market structure from our highest point between tap 2 and tap 3. That's right here, down towards our third tap low. Well, let's check. On the 5, we have no good structure using the 6 candle rule. On the 3, also not, because we don't have 2 candles going down here. On the 2, yes, on the 2 we do. So our structure on the 2 is a high, a low, a lower high, a lower low, a lower high, a lower low, lower high, lower low. Okay. So right here, we mitigate that demand zone. I'm just going to wait for a break of structure. Okay. I'm just going to wait for a break of structure to enter and to go long. If structure doesn't break and we end up doing this, well, price had a reason to, right? Because it wanted to mitigate that more refined zone. And if we broke from there, I would have went long. But market structure is king, and we already broke structure right on that candle close above it. So that's why I would already go long right here. Market structure is king. So we use this entire zone because it looked good, because it was in discount. We knew we had a more refined zone in there, but we did not make that our requirement because it was a 45-minute range. So a 10-minute order block is good enough. And we need to wait for structure either way. And we broke structure right here. So we go long, we put our stop loss below our third tab low, and we target the range high. And this was a beautiful 2.9 risk to reward setup on a Model 2 accumulation. Okay, let's go to the next one. So as you can see right here, price kind of came up, got a move down. Let's check our structure from the high to the low, and we can see that we have a high, low, lower high, lower low, lower high, lower low, move up, breaking structure back to bullish, but then immediately taking the low again, right? Immediately taking the low again right here. And this is a typical sign actually of a range formation. When you break back the bullish, but you take the low one more time, it is a sign of a range formation where it's a bigger range. So if I go into 30, that whole structure will disappear and it's just one move down, right? Low, lower high, lower low. Typical move. If you have a low time frame break and you go lower, it's typically the sign of a range formation. It's a little golden nugget that I'm giving you on this random lecture 5B at the 47 minute. So we have our low, we have our high. We check, price comes back down to the equilibrium, confirming our range. And then what follows, guys? What follows after? After confirming the range, we always check the highest time frame that our range is valid on for the TCT schematic, okay? 30 minute, 2 candles down, 2 candles up, 2 candles down, 2 candles away. There you go. It's on the 45 as well. Yes, also on the 45, we have those 2 candles up, 2 candles down, 2 candles away. Is on the 1. No, on the 1 not. Why? We don't have the 2 candles up here from the range low to your range high. So it is a 45-minute range. That's the highest time frame that range is valid on. Now, very easy. You don't even have to use your DL2 for this one. You have your range low, you have your range high, you have that first deviation. It was just a wick. Okay, it was just a wick. Now, let's check right here. Okay, when can we expect a Model 1 or a Model 2, or where are the requirements met? Well, if I have to pull my most obvious structure from the low up, we have a high and we have a higher low, and then we're growing higher, making this your extreme low. Okay, making this your extreme low. Now, right here, I told you guys we have a 45-minute range. Okay, I told you guys we have a 45-minute range. If you go on the 45, technically it is valid. Technically, it is valid, and I think this could be a very good potential TCT schematic where you have to take an L to get a W. So let's check. Let's check if this is the case right here. So right here, we grab our extreme liquidity. So this would be our extreme liquidity, making it a requirement to get mitigated for a third tap. Let's zoom in if we also have some demand. Yes. Some obvious demand is right here, this 5-minute order block, okay? Again, guys, it's that order block in that pivot point, which will always be the best because they will always be located in extreme demand as well. But very nice 5-minute order block, and we have an obvious low right here, okay? Obvious low. So right here, okay, right here we mitigate, or we grab that extreme liquidity, okay? We grab that extreme liquidity. And there's nothing really special here on the left from a demand perspective that we missed on the second tap. So it could be rational to think that we have a potential Model 2 accumulation schematic. Now, how do we confirm it? If we watch our structure from the highest point between tap 2 and tap 3 down towards our third tap low. This is the highest point between tap 2 and tap 3 down towards that third tap low. Let's watch our structure. We have a high, low, lower high, lower low, lower high, lower low. Okay. Now, that would make this right here your market structure high. We can clearly see that our first attempt, we failed because we SFP'd it. We did not break above it, okay? It's our 5-minute market structure. So we failed and we got the move down, okay? We failed and we got the move down. And then from here, we extend our market structure high to break up following that wick rule that we've been talking about in previous lectures. Where again, we got a move down right here. And then we got the break of structure right there. Now, a few things. Entering on the break right here, you would have to put your stop loss here. And then you target the range high. It's a 2.4. That is decent, okay? That is decent. Now, price ended up coming down, okay? You had some supply right here. You had some supply right above your market structure break, and we kind of broke into that, and that's already an indication of being very sketchy. You don't want to enter on a break that's in supply. What I would do in that situation is, because we have that structure supply right here, and you never want to enter in a supply zone when you're breaking structure, you always want to see if we're going to surpass it, and you'll enter on the retest. So just using market structure, okay, you wicked the low here, you wicked it, but still put in a higher low, and then you wicked it again, and then here we broke it. Now, I would never enter on the break. You can see that we wick it right here. I would always enter on the higher low, okay? I would always enter on the higher low. But that's when we can use our reconfirmation tool, right? I told you guys how to never get trapped entering on fake breaks. Well, using our reconfirmation tool on a lower time frame, like the 3-minute, for example, from top down, we have a low, lower high, lower low, lower high, lower low, lower high, lower low. This is our blue market structure drawing. I taught you guys on the structure lecture, which is lecture 1, that you're only going to be putting in a higher low for a higher high using your red market structure drawing if you break blue. Well, blue was just making lower high after lower low, right? So blue never broke back to bullish, never confirming the higher low. So knowing that you will never enter on a break in supply, okay, and you always want to see what that supply does, you would have to wait for the retest, and the retest never got a confirmation, so you would not get trapped. Now, furthermore, we actually had a Wyckoff schematic right here inside of this third tap. And this is something we'll go over into advanced Wyckoff schematics. So you don't have to know that by now. But if you knew this, you could already enter here, right, with your stop loss here. And you would have already de-risked yourself once you see price coming down like this, okay? So knowing and understanding this mentorship, even though this was a tricky one, you would have not gotten trapped. However, if you did get trapped, sometimes, like I said in the previous lecture, you have to take the L to get the W, because price went lower, mitigating that extreme demand, but we already knew that the Model 2 was failing, okay, because this already met the requirements for a Model 2, and it clearly failed after it broke structure here. So don't really put importance on this demand zone, because the Model 2 already failed. It's not going to work now all of a sudden. It's showing that it really wants to go lower. So right here, we took that low one more time, indicating a potential Model 1 accumulation schematic. Right here, let's extend that low to the deviation low. Now, we're going to apply the exact same thing, right? What's the highest point between tap 2 and tap 3? That's right here. Yes, pull our market structure from that high towards our third tap low you'll get something like this on the higher time frame. There you go. And even here, you have 2 candles up, 2 candles down, making this your market structure high. Okay. Break of structure back to bullish. And right here, we got a candle close above it, and we broke that, and we put our stop loss below the low, and we target the high. So even though this was a trickier one, guys, because our expectation was kind of a model 2, because we had an obvious demand zone and an obvious liquidity point, and there was not really anything underneath that range low, or underneath that deviation low tab 2 to get grabbed. We were expecting a model 2, and the model 2 got confirmed right here, but the break was in a supply zone after wicking up multiple times. So preferably we want to wait for the reconfirmation. And if you wait for that reconfirmation, you would have not gotten trapped. Okay, you would have not gotten trapped. But if you did enter, this is a prime example of when you have to take the L to get the W. I will gladly lose 1 every single day to make 3.3 afterwards. I will take that trade any day of the week. Okay, any day of the week. Any day. So, nice little higher time frame, 45-minute Model 1 accumulation schematic where we hit our target, which was that range high. Okay. Lastly, we have one more, and that will be on Solana. So, what do we see on Solana right here is that we are kind of trending down. Okay, we're kind of trending down. We have our high, we have our low, and we're making lower highs and lower lows right here. Price kind of broke back to bullish just to break back to bearish again, continuing its trend down. Probably if you go on a higher time frame, like the 8-hour, as you can see right here, this is just one downtrend. There you go. So the price is trending down, and we're coming into an area of support. Okay, we're coming into an area of support right here. This is a nice little demand zone, nice little area of importance, and we're gonna check. We see lower highs and lower lows using that structure pool that I just showed you. Lower highs and lower lows. Now, in a downtrend, we pull our range from bottom to top. There you go. We pull our range from bottom to top, and you can see we have a range low, we have a range high, and right when we come to that equilibrium, we confirm it. Now, first thing we do once we have that deviation as well right here, what is the highest time frame that this TCT schematic can be valid on? So we zoom out. This is a 4-hour one. We have 2 candles coming down, 2 up, 2 down. Yes. Is it a 6? No, it's not a 6 because we don't have the 2 candles going up here. So it is a 4-hour range with a 4-hour potential TCT schematic. Always important to know. Okay, always important to know. So after that deviation, we mitigated demand. The deviation stayed inside of our DL2, giving clear signals that it is going to be a deviation and it's not a range break, right? We go up, and right here, when we're hovering around that EQ, we got the move up. Let's check, hey, what is the requirement for our Model 2 accumulation and our Model 1? So for our Model 1, we just extend our range low. We would just extend our range low to the new deviation low, right? And we have to stay inside of this DL threshold. And for a Model 2, let's check where is extreme demand. Well, right here on the 3-hour, you can already see right in that pivot point, we have a 3-hour demand zone. And this is prime example of adjusting your demand based on the size of your range, because we are in a 4-hour range. I'm on the 3-hour now. This is your discount section. Well, divide this into half. That's kind of your extreme discount section. So we have discount and we have extreme discount, right? This 3-hour order block is in that pivot point, and it falls into that extreme category. So we can watch this entire zone. That's fine because it's a higher time frame range. I don't want to, dissect this order block down to the 10-minute and the 1 minute. No, it's just this entire move. Okay, just this entire move down to up, this entire V-shaped recovery. Now, if we have to draw our structure to look at demand, or to look at extreme liquidity, we have a low and we have a high, higher low for a higher high. So using the 6 candle rule, this will be your extreme liquidity. But guys, I want to point out that if you have a demand zone that is this obvious, this clean looking 3-hour order block, and that extreme liquidity is not even in extreme discount, I will pay less attention to the extreme liquidity point and more towards that demand. Okay, it's nice if it aligns, so it grabbed both here, but if one of the two is so obvious and looks so clean, just watch that one. Okay, just watch that one. Well, right here, when price comes into our 3-hour order block, that's when price meets its third tap's requirements, having our 1, 2, and 3. Again, now we check what is the highest point between tap 2 and tap 3. That is this high right here. It went higher than this one. You can see right here it went higher. So we watch our structure on the, let's say, the 30-minute. We have a low, we have a lower high, and we have a lower low. We wait. We have to wait for a break of structure of this downtrend to confirm our TCT schematic. Right here, we have a break of structure, but we have a problem again, because if we enter on this break, putting our stop loss below the low, targeting the range high, we have a 0.4 risk to reward. That is absolutely terrible. Okay, that's absolutely terrible. So what we do is we dissect that last leg down using overlapping structure. Do we have 15-minute structure? No. Let's go on the lower time frame. Do we have 10-minute structure? Yes. We have a low, and we have a lower high, and we have a lower low. Boom. Make that blue. Technically, I think I see even more, guys. I think I see even more. Let's see if we have even more structure inside of our red market structure drawing in this last expansion down following our red. Let's go on the 3. Boom. On the 3-minute, we have a high, a low, a lower high, lower low, and boom, break of structure right here. I think I said boom like 4 times in a row now. So right here, we break our blue market structure drawing. You guys know the domino effect. We can enter on blue because we already met all the requirements, and then we can take it towards our red high. If you break your red high, take it to your black high, and then at that point, your TCT schematic is already confirmed. So see how I'm using that overlapping structure I taught you guys to build context with. We also use it inside of TCT schematics to get a better risk to reward entry, as long as it's reasonable, meaning for a model 1, it needs to be back inside the volume or back inside the original range values, and for this one, it just needs to look good, and you can clearly see that this is just a good look. Okay, why is this a good look? That 3-hour order block is the only order block there is. There's no refined demand zone in here that needs to get grabbed. The third tab requirement is met right here. We can just wait for a low time frame break and then take it up, and this will be an amazing 6 risk to reward, guys. A 6% gain on the trade is absolutely beautiful. Most traders don't even make 5% a week. You can make 6% of your account balance in 4 hours. Okay? So, putting that on our chart, knowing those overlapping structure rules, let's zoom back out again on that 3-hour. We can clearly see by the lovely 1 tab, lovely 2 tab, lovely 3 tab, where the third tab met the requirements, and we target our Wyckoff high, which in these scenarios is also our range high. So guys, I hope this lecture 5B cleared up any confusion you may have had talking about, the theoretical stuff about TCT schematics while drawing it using my path tool. Now you can see it in a real live trading example right in front of you here, and yeah, it's so effective. It's so effective, and it happens so often. It's so effective and it happens so often because even if you guys remember, this is actually the example I gave you guys while looking at, I think it was supply and demand zones, right? I gave you guys this example, and I already gave you a sneak peek of TCT schematics, because we have a massive TCT schematic here, but we also have a TCT schematic right here. And we also have a TCT schematic right here. Remember what I told you guys, if you remember in the lectures, where this was a range low, locally speaking, and we had a model 2 right there that went over into this bigger range right here, that had a model 2 right there that went over into this bigger model 2 accumulation. So I'll get into all these YCOVs and YCOVs and TCT schematics inside of other TCT schematics in the advanced lecture. Okay, first master the basics, but it is everywhere, and it's, in my opinion, something that is not known, and it works extremely good. So I'm like, I'm sharing it with you guys on YouTube for free, but this can change your life. It's that simple. This can change your life. Now, one more thing I want to point out before ending this lecture. In each examples that you guys saw me give, our range is actually looking like a range. I told you guys regarding the deviations to be rational. I told you guys to be rational regarding deviations of ranges. You can see what I mean with rational here. I have a range, I have two wicks. Okay? I have a range, I have a wick and a higher low. I have a range, I have two wicks. They're basically all wicks or bad breakup structures, but in this case, they're all wicks. Oftentimes, guys, they're all wicks. Right here, I think this was a 45-minute one. Yeah, you can see it was more a bad break. It was more a bad break. You see how you have the candle close above it right here, and then you come back inside. You can see that in each example that I'm giving you, it actually looks like horizontal price action. It actually looks like horizontal price action. It actually looks like horizontal price action, where this one is a bit less horizontal because you had a bigger buy to sell, but had a reason to tap that supply zone. But also here, you can actually see price going horizontally, where this was simply a wick. Tab 1 and tab 2 was a wick. Right here as well, you can see price literally go horizontally. Okay, you can see it move sideways. So I don't want you guys to make posts about that you have a range here and this happens and you come back inside and you guys apply your deviation threshold and this is just a massive wick, right? This is a massive wick, meaning it didn't close below it, and then start posting about 1, 2, and 3 like this. 1, 2, and 3. Okay? I don't want you guys to be doing that. I want you guys to be rational and take these as examples. This is what you want to see. A horizontal range. A horizontal range. Sideways price action. Horizontally. Horizontally. Look how clean this is. You can see it go horizontally. Same over here. You can see price move sideways. Okay? So I just want to clear that up, that yes, you have that DL2 to measure deviations with in order if a deviation is still a deviation or a break, but I want you guys to be rational as well, because a range is just horizontal price action. And these are all trades. Everything I have showed you here is something I have traded. Okay? Everything I showed you here is something I have traded. And you can also just go to my post-trading analysis videos on YouTube, and you'll see that every time that I trade a TCT schematic, it actually looks like a range. Because I've been getting many questions already on X of people showing me their setups, and they're technically speaking valid setups, but rationality-wise, it's like terrible, right? So just something to also pay attention to, that I'm trading real ranges here. You have a range here, and you have a range here, and both look like clean ranges, okay? So, hope you guys understood the video, put it to practice, especially guys, put this to practice, what I've taught you now, put this to practice first before going to the advanced tutorial, okay? Before going to the advanced tutorial, because then we're going to be talking about TCT schematics flowing over into one another, where a Model 2 flows over in a Model 1 or a Model 1 in a Model 2. We're going to talk about TCTs within TCTs. We're going to be talking about many other things. Low time frame ranges into high time frame ranges, all that stuff. Okay, the more advanced concepts. But before you can master any advanced concept, you need to master the basic concepts, and these are the basic concept with the basic rules and the foundation. And this can already make you very profitable. But you know that loss that you could potentially take on this Solana setup. Which one was it? Oh, right here. The loss that you could have potentially taken on this Peppa trade will be cleared up in the advanced lecture. Okay? So, see you guys in lecture 6. Peace out.